Hey, good morning, everyone. Marty Mazzora here. Thursday, October 3rd, 2019. Market update for you. Decided to wait a little while this morning. It's about an hour and 15 minutes after the open. Wanted to see the ISM services survey come out first and see how the market responded to it. Kind of, frankly, looking for a relief rally or a bounce in here. Looked like we might be getting a little bit of it in the morning right off the bat, although the market was mixed to a little bit higher. But that didn't play out. Once the ISM survey came out, then the Dow, for example, just plunged about 200 points. The S&P was down over 20 points. As you can see, this is today's candle. Let me zoom in on that for you. Here's today's candle. So we're fighting back. As you can see, the market did bounce right in here. Interestingly, all I could see to kind of inspire that bounce was commentary from the president, and he just simply said that next week China's delegation is coming and we have lots of options. So, still, just about anything that even smacks of a little positive tone with relation to the trade war with China can spark a rally. And while the market's still down, looks like maybe we're moving back down a bit. Going from down 20 on the S&P to a point where we were almost even. That's a pretty substantial move on such an opaque comment from the president, if indeed that was it, or it could be just time. If I look in here, 2860 or so, if I were to zoom out, and you can actually see it in here, 2860. Let me get my drawing tool up. 2860 right here, you can see there, there may be some technical support right in there. There may have been some traders poised to buy that if indeed we get a little bounce. So maybe we bounced off of here a bit, and then then some money came in, and maybe a little bit of short covering. Although I don't think there's anything dramatic happening there right at the moment. So again, though, I think it's that sort of thing, a tweet, a comment, something around trade that's positive. Now, I was looking for a bounce, as I said, but I was also concerned about a news flash right after the open yesterday, and that is that the U.S. had the green light to apply tariffs on 7.1 billion of European imports. And then a little later, we had confirmation from Washington, apparently from someone on their trade team, that said, yeah, we are going to go ahead and take advantage of that. And then I believe it was early this morning, a tweet from the president said, we just got a victory at the WTO. So it has to do with a long-standing dispute with Airbus and subsidies for Airbus from Europe. And what is also pending, by the way, is the same thing that has to do with the complaint by the European Union about U.S. subsidies for Boeing, and that is yet to be settled. But right now, the complaint with regard to Airbus was settled in favor of the U.S. But make no mistake, folks, if we are about to engage in anything remotely like the situation with China, if we're going to go there in Europe, we are going to have more of a mess on our hands. So, with the market in mind, I keep thinking I'll be really surprised if we go there, but yesterday's news suggests maybe we will. The president has said since before he was president that he wanted to tariff German automobiles, and he's going to have that opportunity next month if indeed he wants to go there. That makes for a lot of uncertainty. It also makes for big market spikes higher if and when we get news that those things aren't going to happen, or they're not going to happen to the degree that traders might fear. So while I can ramble on and on, I can kind of sum it up with a couple of things. Number one, the fundamental reality is something we've been talking about here for months and months, and that's been deteriorating under the surface. And I'll show you the ISM chart here in a second. On top of that, we have the technicals. And as I've been saying a lot of late, certainly on the longer term charts, the market is looking very heavy to me. Take a look at the MACD, moving average convergence divergence, and the RSI. On top here, I have the RSI. This is just a real heavy look. And when I zoom out, you can see this is just the trend. We have the market right here, just about getting to all-time highs, but you can see more rolling over here in the relative strength index. In fact, if I do zoom that back out, You can see here, as the market did make its way to this marginal new high, the RSI rolled over sooner. Virtually exactly the same thing here on the MACD. And if I go ahead and zoom out and look at a 3-year chart, as you can see from the January high of 2018, this is where we began getting concerned. We were seeing these breakdowns. You can see we got a marginal new high. Nothing even close here on the MACD. Similar look for the RSI, by the way. Marginal new high, marginal new high. You go back historically, folks, and I've shown you on the weekly and on the monthly, this is the same look. This is just really not a good look, along with what is an upward sloping wedge pattern. This is the look that we had before the last two real major bear markets, and it tends to be the look that we get before substantial corrections. So hence, from a technical perspective, my very cautious tone here in the videos and then on the blog for months and months. Now, from a fundamental perspective, which is really where we spend the majority of our time, things have been breaking down for quite some time. I've been showing you our own proprietary index. It peaked back in January of 2018, a time, ironically, when I was very bullish, but I did offer up the caveat on the blog that a trade war is the one thing that would put my bullish thesis to a severe test. And that is precisely what we've been getting. So I've maintained all along, though, that as long as conditions hold up and we end the trade war, we could get back to a scenario, which is what I was expecting back in here. And that is that this economy probably has a ways to run. Yeah, we'll go through consolidation phases and the market will go sideways and have corrections. But my observation back in here was that we were still in pretty good shape. But I did continue to say that we are going to get to a point where conditions, if they continue to deteriorate, are going to get to the point of no return, where you can end the trade war and you're not going to be able to avert recession. So here's our chart of the ISM survey results. And notice the purple line is manufacturing. So if you go back here, which covers the life of the services sector survey as well, notice back in here when the manufacturing survey topped and began to roll over. It was a few months later before the services sector actually followed suit. In fact, pretty good span of time in between these 2 points. The mid-2000s, we peaked way back here. The services sector survey didn't peak till here, but folks, above 50, you're still in expansion mode. So we were encouraged with this big move here, but then we began to roll over. Notice the service sector, my point is, tends to come after the manufacturing sector. And hence the idea that while services is certainly a bigger part of the economy and it reflects the consumer's activity, where the manufacturing sector really reflects what's going on under the surface. Watch manufacturing. Even though it's smaller, it tends to be more of a leading indicator. And the services sector data tends to follow. So here is manufacturing rolling over well into recession territory, the lowest point of this expansion. Very concerning, and that's why the market fell several hundred points in the 2 days since that report came out. And here's this morning's services sector survey. Still in expansion mode at 52.6, but that's the lowest report since 2016, and the trajectory is not good. Reading the survey, again, businesses are expanding. That's why we're above 50, but at a much slower pace. And what do they reference? Tariffs, trade wars, uncertainty, and so forth. I'll say it again, folks. The notion that we are going to heat up disputes over trade with Europe, and we still haven't even come to any conclusion with China. And when we ultimately do, I do still expect a very strong short-term rally in the market. But at this point, given the macro, given what we're seeing, given our assessment of conditions, we'd have to conclude that probabilities would strongly suggest that it'll be a very short-lived rally and that we'll continue to move our way down into lower lows. I'm open to all possibilities if indeed we do see some of these fundamental indicators begin to improve in a big way, and I think the economy is back on track, then of course we're going to tell a different story and we're going to be acting differently within client portfolios. So those are our concerns. Number one, what's going on the surface? What do probabilities suggest about the future going forward? Right now, that's not a good picture in our view. Technically or fundamentally. Yes, we'll get big spikes in the market. Yes, we could end the year rather strong in stock. But of course, I'm talking about more than just the stock market. I'm talking about ultimately what makes the stock market work? Where is the buying coming from? Is it mostly share buybacks? I wrote about that yesterday. What are the earnings prospects going forward? So that would be the macro. What are the conditions that it would allow for companies to really grow their earnings and therefore justify higher stock prices and so forth? The stories that I would tell about those conditions right now, and I've been telling, aren't good stories. And then secondarily, under the surface, we do roll over. We do get into recession. What's it look like under there? Looks really ugly, particularly in the corporate debt market. So we have to be careful right here. I'll leave it there for this morning. I'm working remotely this week, so I may not be as active as I usually am on the blog, certainly not in the afternoons, but I'm sure you're getting probably more than you need nonetheless. Thank you as always for watching and listening. Talk to you again soon. Bye-bye.